What's up, everybody? This is Sunko, the Korean bro. Today is 2023, August 8th, and let's read today's market, okay? You can't control oil prices, but you can control what you do about them. Amazon is beating the inflation beach. Time to buy the stock. Alibaba stock has a lot to prove this week. Uh, hmm. Oil has a long history of dramatic and rapid price volatility. Energy prices have a very direct top and bottom line impact on most energy companies, but not all. With a little extra care, you can position your energy exposure to best serve your investment temperament. Amazon is beating the inflation beach. Time to buy the stock. Amazon is calling unnecessary expenses created by the rapid response to the COVID-19 pandemic. Meanwhile, its higher margin businesses like advertising and cloud computing are offsetting those costs. The stock is affirmed by again as last quarter's rekindled profitability could be just as thought. Given the stock's post-earnings rally, the market is largely in agreement that Amazon's quarter-second profit growth represents the new norm. Indeed, the big gains suggest investors feel the company is likely to sustain those cost reductions, while at the same time it's streamlining the spend it can't cut and driving more and more higher margin revenue. The market is arguably right about this assumption too, making Amazon a compelling purchase again. A newcomer's only consideration here might be the sheer scale of Friday's jump. That's a tough act to follow, as some owners may be taking profits soon. Just don't hold out too long, waiting for a fantastic price. You might not get it. This isn't a stock with a history of making major pullbacks when the company's firing on all cylinders, as it again is now. Chinese e-commerce giant delivers quarterly results on Thursday. There's a lot riding on the report. One of China's most prolific growth stocks will be reporting fresh financials this week. A lot is riding on what Alibaba Group has said when it announced its fiscal first quarter results a couple of hours before the market opens on Thursday morning. The e-commerce giant hasn't been an inspiring investment on this end of the pandemic. The shares were nearly cut in half in 2021, going on to shed another quarter of their value last year. The stock is trading higher this year, but with a year-to-date gain of less than 10%, it's losing to the market for the third consecutive year. A strong report can get Alibaba's back on track. It could also get the Chinese bellwether back on the radar of growth investors. Expectations are healthy but not historically high heading into this week's critical update. Analysts see revenue and earnings per share rising 10% and 25% respectively for the first quarter of fiscal 2024. After posting six consecutive quarters of single-digit year-over-year growth, it could be a long overdue return to double-digit top-line gains. It's what it is about Alibaba. You know, Okay, let's see. Some Wall Street professionals think a new bull market has already begun. There's debate raging on Wall Street about the official status of the stock market. In June 2022, the benchmark S&P 500 index closed 20% below its all-time high, which marked the beginning of a technical bear market. That much was agreed upon, and the market continued to slide until October 2022. It was recently up more than 20% from that October low point. Bank of America was quick to declare the beginning of a new bull market, but other market professionals can contend that the S&P 500 needs to hit a new all-time high before it earns that official status. Raffin. To say Raffin's business struggled recently would be a drastic understatement. In 2022, the U.S. Federal Reserve embarked on the most aggressive campaign to hike interest rate in history in order to tame a 40-year high inflation. That put the brakes on the housing market, which had been hot throughout 2020 and 2021, thanks to near record low mortgage rates, waves of pandemic-related government stimulus. Raffin was forced to close its Raffin Now outbound segment in late 2022 due to the shifting environment. Involved the company buying homes directly from the willing sellers with the intention of flipping them for profit. But as real estate prices cooled, the company risked losing substantial amounts of money in its property inventory. Drawbone made up more than 50% of Raffin's total revenue, so plugging that hole won't be easy. It's using new tools or artificial intelligence to deliver a more efficient search experience for buyers. Raffin now has a plugin for a ChatGPT chatbot, uh, which serves as a virtual assistant to feed users property listings within a specific criteria they set. This should help users avoid spending endless hours scrolling on real estate websites. So Raffin, uh, Apple, Amazon, and what else? Snowflake. Hmm. Data warehousing company Snowflake. The $987 million Berkshire Hathaway held in Snowflake stock as of the closing bell on August 3rd, coupled with the company's positions in Apple and Amazon, collectively add up to 47% of invested assets. Snowflake is best known for its cloud infrastructure, which is built atop the most popular cloud infrastructure services. Whereas sharing data can be a potential headache uh, when stored on competing platforms, Snowflake's layer solutions make data sharing a seamless operations for its members. The being used in 2023, Snowflake's addition of generative AI solutions to the data clouds of its vendors made Snowflake complete its acquisition of Neva, a company that was powered by generative AI and large language model technology. In addition to aiding customers in developing generative AI applications, Snowflake has partnered with NVIDIA, the graphics processing unit designer, a retailer seen as the infrastructure backbone of high compute data centers. This partnership gives Snowflake's users access to NVIDIA's high-powered GPUs. AT&T is growing its wireless business in a tough environment while expanding its fiber network. Free cash flow generation is solid enough to make progress in paying down the debt and funding a generous dividend. Let's talk about Arista networks. Okay, a direct line to the AI revolution. Arista Networks is a leading provider of high-performance cloud networking solutions, enable faster and more efficient data transfer across various platforms. This company is at the forefront of the artificial intelligence revolution, as AI applications require high-speed networks to function optimally. Arista, which specializes in advanced routers and switches for data center and network communications companies, has a competitive edge in this rapidly growing market. Arista's strong position in AI infrastructure has been reflected in its impressive financial performance recently. Its latest quarter, the company beat analyst expectations for both revenue and earnings, thanks to the increasing demand for AI solutions across different sectors. Arista also projected a robust 30% growth in its revenue in 2023, driven by the continued expansion of AI architectures. Arista stock has been richly rewarded for its stellar financial performance this year, with its shares up 47.6% through the first 7 months of 2023. As a result, the networking giant stock is currently trading at over 30 times forward earnings, which isn't exactly a bargain from a historical standpoint. However, the premium valuation seems to be justified by the enormous potential of AI. After all, AI will only become more pervasive and influential in the future. Arista is a key player in AI infrastructure, stands to benefit from this long-term trend. Let's talk about three uh, cloud stacks to buy out. The cybersecurity company should benefit from its ability to leverage crowdsourcing it to its advantage. This cloud infrastructure stack faces rough seas. It holds an ocean of potential. The data cloud should take its long-term gains to the clouds. What tech's showing signs of recovery, now is likely a great time to buy cloud stocks. Nasdaq Composite is up by approximately 35% this year, which is primarily thanks to cloud stocks. The cloud market, which reached more than $480 billion last year, is expected to grow to about $1.55 trillion by 2030, according to Grand View Research, a compound annual growth rate of 14%. As we begin August, many investors, particularly risk-averse ones, might lean toward the mega caps in the field, such as Amazon or Microsoft. While investors can certainly choose the odd option, there could be more profit potential in smaller stocks such as CrowdStrike, DigitalOcean, or Snowflake. CrowdStrike. The cloud cannot exist without cybersecurity, as limiting network access is critical to its success. While numerous companies compete in this space, CrowdStrike, which earned its name with its ability to leverage crowdsourced data, has attracted attention because of its ability to secure endpoints, laptops, servers, smartphones, and other devices that access networks. The company then drives additional revenue by selling modules or security add-ons. About 62% of its customers use at least 5 modules. Its dollar-based net retention rate continues to exceed 120%. This means existing customers increase their spending on the platform by more than 20% on average. In its first quarter of fiscal 2024, the $693 million in revenue rose 42% year over year. Also, its $491,000 in net income was the first generally accepted accounting principles profit in company history, a factor that should help the stock among investors who have become less tolerant of losses. Admittedly, CrowdStrike may face some headwinds. The forecast fiscal 2024 revenue of just over $3 billion would mean a 35% revenue increase, a slowdown from current levels, and the 15 price sales ratio, while low by historical standards, is at a 2023 high. But as cloud adoption continues, it should mean CrowdStrike grows at a rapid clip for a long time to come. DigitalOcean, Snowflake. Let's read Snowflake, okay? One critical part of the cloud is the data management, and Snowflake seems to offer the best product for this task. Its product stores, secures, and limits access to data sets. It stands out as a plug and play. making setup easy. It is also interpolable, meaning it holds no bias toward cloud infrastructure supported by a specific company. Snowflake's popularity continues to grow as it now boasts nearly 8,200 customers. Also, its net dollar retention is an astounding 151%, which bodes well for continued revenue growth. Given that factor, one can understand why the company estimated a $248 million total addressable market for the data cloud by 2026. For now, the $624 million in revenue for quarter first of fiscal 2024 is a small fraction of that. Nonetheless, that revenue grew 48% year over year. Indeed, Snowflake is not a perfect stock. Its quarterly loss of $226 million increased from a year ago levels, and the rapid revenue growth is probably one reason for the cloud stock's 23 PS ratio. However, its sales multiple has never fallen below 20, and the company's revenue levels indicate it has barely begun to capture its revenue. Those factors should help boost Snowflake over time despite its considerable expense. But let's read some stuff about Datadog. 50 chart tells the story of the economy and markets today. Okay, let's read this one. Well, Datadog. Okay, let's look at Datadog. Minus 19%. Okay, that's good. Okay. Hmm. Through the year's first 7 months, 2023 has defied investors' expectations. The U.S. economy continues to grow as the economists abandon recession forecast. The stock market has staged a rebound rally after enduring its most challenging year since the 2008 financial crisis in 2022. Inflation is falling faster than expected. Home prices have stayed firm against mortgage rates that have topped 7% at the times. Consumers are still spending down their pandemic savings. In our first edition of the Financial Hardbook, each of these themes play a prominent role. Across the 50 chart featured in this collection, however, emerges a sense that we are waiting for something to happen. For that proverbial other shoe to drop, there is a knees churning below the ears calm surface. Credit spreads are eyed, leading economic indicators flagged, lag effects of the Federal Reserve's aggressive rate hikes are being monitored, and there are nascent signs of softening in the consumer. The corporate flavor of the moment, artificial intelligence, only appears by inference, lasting for the broader investor community, perhaps. At a moment for investors in which consensus feels particularly elusive, our chart book is in keeping with the times. We can't wait to hear your thoughts. The market may be at that point now as the summer winds to a close. One top Wall Street strategist argued three reasons why the stock market rally may be stopped in its tracks. Okay, we deserve to be where we are, but do we have enough coming to really get the market incrementally excited from here from an economic perspective? Hmm. First, rising earnings for S&P 500 companies is a phenomenon that has largely played out this year. Okay, investors usually race to buy stocks when analysts are lifting profit and cash flow forecasts on companies. Remember, the present value of a stock price reflects expectation of future cash flow. So bad news is stocks have become extended on a short-term basis. Short's co-chief investment officer Keith Lerner said, valuations have pushed to one of the richest levels of the past few decades. Investors' expectations have been reset sharply higher as we head into a more challenging seasonal period. Hmm. We are in the greatest credit bubble in human history. Uh, Last but not least, I'm going to read stock about Datadog. Datadog is one that I invested into, and it's now down by 20%, which is ridiculous. Because I mean, like stock like this is treated nicely, but then it's now down by 20%. I don't know why. There's no news about why it's down by 20%. Hmm. What happened to Datadog? Hmm. Okay, let's see. Learning artificial for IT operations. Okay, let's see. Datadog specializes in observability and cybersecurity software for development, operations, and security teams. Its platform integrates data from across the corporate technology stack to provide organizations with real-time visibility into their applications, networks, and infrastructure, helping them identify and fix performance issues and security threats in a timely fashion. Datadog has also infused its platform with a powerful artificial intelligence engine that can automate the detection, investigation of problems to accelerate time to resolution. Indeed, Forrest Research recently recognized the company as a leader in AI for IT operations, citing its ability to provide superior data insights and visualizations. Its more extensive team of data scientists, its impressive innovation pipeline as a key differentiators. Other industry analysts share a similar positive perceptions of Datadog. Customs is from Gartner recently recognized a leadership in application performance monitoring and observability software, citing its broad portfolio of well-integrated products as a key strength. A research company G2 recently recognized Datadog as a leader in network monitoring, log monitoring, database monitoring software. Innovation machine, Datadog's strong foothold in several observability software verticals, has consistently translated into solid financial results, and that pattern continued in the first quarter. Its customer count increased 29% to 25,500, and the average customer spent north of 30% more in the past year. In turn, first quarter revenue rose 33% to $482 million, and non-GAAP net income jumped 17% to $0.28 per diluted share. Looking ahead, investors have good reason to believe Datadog can maintain its momentum, as the company has demonstrated an extraordinary capacity for innovation over the years. What started as a simple real-time data platform has evolved into an extensive suite of observability and cybersecurity software. Its product portfolio continues to grow quickly. Datadog recently introduced a workflow automation product that streamlines the entire remediation process. It also debuted as a data streams monitoring product that helps prevent downtime in data pipelines that supply critical applications. And it announced new integrations with OpenAI that allow clients to monitor usage patterns, performance, costs associated with generative AI models, including the GPT family of large language models that power ChatGPT. Why Datadog stock is worth buying. Looking ahead, the investment thesis for Datadog is straightforward. IT environments are becoming more complex as organizations undergo cloud migrations and other digital transformation, and that trend means observability and cybersecurity software are becoming increasingly important. Indeed, while Datadog estimates its total addressable market at $45 billion this year, management expects that figure to reach $62 billion by 2026. So while Datadog is already well positioned to benefit from that opportunity, given its strong presence in the several observability software verticals, its capacity for innovation is an added bonus that should keep the company on the cutting edge of the industry for years to come. With shares trading at roughly 20 times sales, not a cheap price, but still a significant discount to the 3-year average of 36.7 times sales, patient investors should consider buying a small position in this AI growth stock today. Okay, one more article, okay? It helps business monitor their cloud-based operations from the back end to consumer-facing sales channels. The need for such tools is constantly growing, especially among large organizations, because businesses are more reliant than ever on cloud computing as an alternative to physical locations, whether that be shop fronts or offices. The cloud has powered the work from home trend by allowing employees to access their jobs remotely from anywhere, and also opened the door to a global customer base for millions of businesses, small and large. While the latter comes with significant sales opportunities, it also creates challenges because the cloud has powered the work from home trend by allowing employees to access their jobs remotely from anywhere, and also opened the door to a global customer base for millions of businesses, small and large. While the latter comes with significant sales opportunities, it also creates challenges because every online touchpoint with customer generate data, which is only useful if it's being monitored. For example, determining customer satisfaction in the physical store is easy. The clerk can observe shoppers' behavior and also take immediate vocal feedback. But in an online store, customers are a click away from a competitor, so the experience needs to be clean, fast, and frictionless. If visitors run into technical glitches, they are likely to immediately shop elsewhere. The business won't know until it sees a downtick in revenue. That's where Datadog comes in. It monitors cloud infrastructure around the clock so it catches problems the moment they arise, before they impact the customer experience. That's why 25,500 businesses are currently using the platform, including 2,910 of which are spending $100,000 per year. They come from diverse industries, from retail to entertainment to healthcare. Based on Datadog's $1.8 billion in trailing 12-month revenue and its market valuation of $34.9 billion, the stock currently trades at price to sales ratio of 19.4, Assuming that number remains constant between now and 2033, Datadog will have to grow its revenue by 14.9% per year to justify for gain its stock price. In the 5-year period between 2017 and 2022, the company's revenue grew at a whopping compound annual rate of 75.5%, which will be more than enough to get the job done. It's expected to slow to a rate of 25% in 2023 because of the tough economic climate. But Datadog continues to increase its revenue forecast, so there could be upside to that number. Okay, it's getting a bit late, so I'm gonna see you tomorrow. Okay, bye bye, and see you, and have a good night.